Good day, my name is Adrian Meager and I'm the Chief Investment Officer of Orion Investment Managers. In my last video, I discussed the differences between bottom-up and top-down investing. Today I'm going to unpack the differences between growth and value investing. Growth shares have the potential to achieve growth that outpaces the market average. These often include companies at the leading edge of technological developments or pioneers of innovative products and services. Examples could be Amazon or Apple. The defining characteristic of value shares is the belief that the current share price is lower than the real or the intrinsic value of the company. In other words, they are regarded as assets trading below their true worth or are undervalued. Value investing involves identifying companies that have suffered short-term solvable problems that have affected either the company's profits or its share price, but where the long-term prospects are still believed to be good and shareholder returns look attractive. These investments can be out of favor for numerous reasons, including weak short-term profitability, economic concerns, or they have a poor balance sheet. Well, one way of differentiating between growth and value shares is to compare their price to earnings ratio or PE ratio. Growth shares have higher PE ratios, often above 25 times and sometimes considerably higher. Investors expect a high level of growth in earnings and are therefore willing to pay a higher price relative to the company's current earnings. By contrast, value shares have a lower PE ratio, often around 10 to 15 times, and in some cases even lower, indicating that the market is valuing the company at a lower multiple of future earnings. Another difference is the dividend yield, which is a proxy for the annual return to a shareholder in income. Growth shares generally have a low or zero dividend yield, as excess cash is reinvested in the business to drive future earnings growth. Value shares typically have a higher dividend yield, often upwards of 5%, providing an income for investors together with the potential for capital growth from the upside in the share price. Growth shares are more prevalent in technology, communications, and biotech sectors, while value shares are often found in the financial, consumer staples, and energy sectors. One of the main benefits of investing in growth shares is the potential for higher share price returns if companies can successfully deliver above average earnings growth. Growth shares also tend to outperform during favorable economic conditions when investor confidence is high. However, the performance of growth shares can suffer when interest rates rise. One method of valuation is to look at the present value of a company's future cash flows by applying a discount rate, which in its simplest form is the cost of borrowing money. Higher interest rates increase the discount rate used in this calculation, which reduces the present value of future cash flows and by extension, the company's valuation. An economic downturn can also prompt investors to de-risk their portfolios by reducing their holdings in growth shares, which also puts downward pressure on share prices. In addition, growth shares are typically more volatile than value shares. Investors have high expectations of earnings growth, and if a company fails to achieve forecast earnings, then this can lead to significant falls in the share price. One of the key advantages of value shares is the opportunity for share price appreciation if the price re-rates upwards to reflect the company's increased intrinsic value. The market often underestimates the ability of a business to improve their situation over time, and as a result, investors who are willing to take a longer-term investment horizon can benefit from strong returns. Value shares typically perform better during an economic downturn, particularly those businesses with resilient business models in more defensive sectors. Value shares often pay attractive dividends, which may appeal to income-seeking investors. The main downside to value investing is that we do not know how long it will take for the market to recognize the value in a company, and returns can be volatile over short time periods. Remember that value investing is inherently contrarian, as the best investments are often found by going against the crowd. So this is an approach for the longer-term patient investor who can accept periods of capital loss. Firstly, it's not always possible to classify shares as either purely growth or value, as they may exhibit attributes of both. Secondly, there can often be a temptation to look at growth and value styles of investing in a two-dimensional way. This assumes that value investors only look at cheap stocks, while growth investors are agnostic as to the price, and they will pay up on the basis that companies that offer exceptional growth command exceptional valuations. Acorn, Palmyra, and Capita Asset Management believe in the importance of fundamental analysis to determine the valuations of a share, as only the analysis of underlying company and its prospects relative to the market expectations can give any sense of whether the upside is attractive relative to the downside risks. In conclusion, market values can move a great deal, both up and down, in brief period. So by blending aspects of these two investment styles to determine the attractiveness of a share, we aim to build diversified portfolios that meet the unique financial goals and objectives of our investors. Thank you. We hope you enjoyed watching today's video, and we look forward to bringing you more content in the future. Goodbye.